The economic cycle is like the four seasons: summer, fall, winter, and spring. And these four seasons represent different phases of the economic cycle: expansion, contraction, recession, and recovery. Let's start with the expansion. Macro summer is when growth and inflation are rising, the economy is expanding, and financial conditions are relatively easy. Risk assets perform while non-risk assets underperform. Now, sometime during macro summer, financial conditions begin early stage tightening to prevent inflation from getting out of hand. Policymakers and economists will call this the reflationary phase of the economic cycle: rising growth and rising inflation. We call this macro summer. The 1920s were one of the strongest bull markets in history, where macro summer appeared twice, and each time stocks gained 50%. In the 1950s, macro summer sent stocks up 74%, and from 2016 to 2019, stocks gained 75%. The fall contraction. Macro fall is when inflation is rising while growth is either stagnant or falling. The economy is contracting while financial conditions reach max tightening to vanquish inflation pressures. And that tightening puts further downside pressure on growth. Economists refer to these conditions as stagflation. We call this macro fall. Policymakers are in a bind because they can't just re-stimulate growth for fears of accelerating inflation. For the most part, risk assets underperform, with the exception of commodities and inflation hedge stocks. Non-risk assets are mixed. The dollar rises as a safe haven, but bonds underperform. Now, the late 60s to early 70s was a decade of stagflation, macro fall, and this resulted in 4 bear markets, 4 recessions, and the highest interest rates in recorded history. Commodities like gold and oil outperformed, along with oil and gas stocks. The dollar also performed as a safe haven asset and a fixed income instrument because savings accounts paid as high as 18% on cash. The 2000s also saw periods of stagflation that led to overall negative annual returns for stocks, which was one of the worst decades ever for the stock market. The winter recession. Now, eventually, the pressure from tighter financial conditions crushed growth and inflation. Macro winter is when both growth and inflation are falling. The economy is either in or headed for recession, the recession phase of the economic cycle, and financial conditions begin to ease to prevent a larger downturn. Policymakers and economists refer to these conditions as deflation. We call this macro winter. Risk assets underperform, while non-risk assets outperform because they're considered safe haven or recession hedge assets. In 1929, macro winter sent stocks down nearly 90%, while the dollar spiked significantly as investors raised cash. In 2008, macro winter crushed stocks down 55%, while the dollar and treasury bonds gained significantly. The 2020 pandemic saw stocks drop 35%. Macro winter doesn't last long because of the aggressive stimulus response unleashed from policymakers, which leads us into macro spring. Macro spring, the recovery phase. Macro spring is when growth is accelerating while inflation is either falling or sitting at low levels. The economy is recovering and financial conditions are easing. Risk assets outperform while non-risk assets underperform. Policymakers and economists refer to this as the disinflationary phase of the economic cycle, or the Goldilocks scenario. We call this macro spring. In the late 1920s, macro spring resulted in stocks gaining 100% in just a couple years. The 1950s had macro spring twice, once gaining 60% and the other 50%. In the mid-1990s, the S&P gained 100% and the NASDAQ 250%. During this phase, we usually see the best performance out of the riskier assets because both inflation and interest rates are low while liquidity is increasing. Hence the phrase Goldilocks, the golden scenario. So what have we learned here? Risk assets perform best under macro spring and macro summer because they have easier financial conditions and a strong economy behind them. Commodities and some stocks will perform during macro fall because they are the inflation. The dollar performs best when financial conditions are tightening or the economy is at risk of falling into recession, so macro fall and macro winter. Bonds hate inflation, but perform best when growth is at risk, so macro winter. The macro seasons help us to frame the current market conditions so we can anticipate how different assets respond in different conditions. It's pretty much a navigation tool. It points us in the right direction according to the model. The true power of the macro seasons is that it offers investors the ability to forecast a high probability of outcomes. Next, we're going to look at the post-pandemic cycle as a case study for how cycles transition from one season to the next.